Welcome to the Deep Dive, where we cut through the noise. If you want to know what's really moving markets on December 12th, 2025, you're in the right place. And today, it all comes down to one thing: central bank policy.
That's exactly it. It's not about earnings this week. It's about the Fed fundamentally adjusting how it manages liquidity. And the market is basically holding its breath.
Okay, let's unpack that. Our sources are all pointing to the Fed's new implementation note. For anyone who hasn't been reading Fed statements for fun, what did they actually just do?
They rolled out a whole new suite of tools. Think of it as a pivot. Yesterday, December 11th, they officially started the standing repo and the RMP rules. These are the basic plumbing tools.
Right, the guardrails to keep rates in a certain lane. But the proactive part, the big news, is the RMP, correct?
Exactly. RMP are reserve management purchases. The Fed wants to make sure bank reserves don't get too low, so starting today, they're launching RMP. We're talking about $40 billion in short-term security purchases just in this first month.
$40 billion. So this isn't QE, it's a very tactical liquidity injection.
Precisely. It's targeted. The Fed is basically saying, don't worry, we've got this. But the market reaction has been, well, two things: cautious positioning and very event-driven moves.
I see that tension. The Fed is trying to project calm, but investors are cautious. How does that show up in the bond market, in the actual data?
Well, you see a really tight holding pattern. The 10-year Treasury yield is stuck right around 4.13%. It's just bouncing between like 4.1 and 4.17, and the 2-year is even tighter, around 3.53%.
Okay, so the short end of the curve is listening to the Fed, but the long end is still uncertain.
Yes, that's a great way to put it. And that uncertainty spilled right over into currencies. The dollar index, the DXY, took a step back.
I did see that. It fell from near 99 down into the 98.3 to 98.8 range. Why the drop?
Because if the Fed is guaranteeing liquidity, there's less of an emergency rush into the dollar as a safe haven. It just, takes the immediate pressure off.
And the risk gauges, what's the VIX telling us?
The VIX is around 15.8. So not panic, but it's not relaxed either. It's sensitive. And if you look at crypto, the fear and greed index is way down in the fear zone, around 29, deeply cautious.
So let's connect that macro picture down to specific stocks. How did this cautious, policy-driven environment hit the market?
We saw a split. This is where that event-driven part comes in. Money is flowing back to cash for a moment, waiting to see what happens. So the broad market, say EVOs, is just kind of moving sideways between $628 and $632. But the tech-heavy QQQM is a bit more volatile, bouncing around $256 to $259.
And what about those event-driven movers? Let's get specific. I saw NVDA was active.
Oh yeah, NVDA was all over the place, between $181 and $184. It was all driven by news about its H200 chip and exports to China.
The H200 is their big new AI chip, right?
The biggest. Any hint of regulatory change on whether they can ship it to China sends the stock flying. That's a huge catalyst.
Makes sense. What else moved?
We saw pop in CRCL, which is Circle. They just secured a major license in Abu Dhabi, the ADGM FSRA license.
Why is that a big deal?
Because it opens up huge Middle Eastern markets for them. It's a massive signal for global stablecoin adoption, a regulatory win.
Got it. And what about Coinbase and Robinhood?
Yeah, Coin and Hood. For them, it's all about trading volume. Coinbase reopened registrations in India, which is a huge potential market. And for a platform like Robinhood, all this event-driven volatility just means more transactions, more revenue.
Okay, let's pivot to crypto itself. Bitcoin is still at a high level despite the fear. What's the range?
It's holding around $92,700. But the range is pretty tight for Bitcoin, maybe 90K to 94K. Ethereum is sitting near $3,250.
And is Bitcoin still holding that volatility premium over gold?
It is. The BTC to gold ratio is about 21.7, so it still takes nearly 22 ounces of gold to buy one Bitcoin. Gold is stable above $4,200, but Bitcoin is still the high-risk, high-reward play here.
This is a great breakdown, so to bring it all home, what's the takeaway strategy for someone listening right now?
The main thing is risk control. Flexibility. I would strongly advise against any big one-time investments at this moment.
So don't go all in on a dip.
Exactly. Use staggered purchasing. Buy into the big indexes like VOO and QQQM in small bits over time. Average your way in.
And for hedging, with the Fed actively in the market,
a small allocation to short-term treasuries or a gold ETF makes a lot of sense. It's counterbalance. And for your speculative assets, BTC, ETH, keep the exposure small and definitely not leveraged.
I think that's solid advice. But let's look forward for a second. We've talked about the Fed's announcement, but the thing everyone is actually waiting for hasn't happened yet, has it?
That is the single most important thought right now. The market has priced in the intent. Now it's waiting for the execution.
The actual purchases.
Yes. The crucial thing to watch next week is the Fed desk's first RMP operation. We need to see the volume, the frequency, how the market reacts in real time. If it's too little, too much, too slow, any deviation could cause the next big shift. The real test for the market starts now. That is the one thing you need to watch.